Our other guest is Lee Munson, President and CIO, Portfolio Wealth Advisors, author of Rigged Money, Beating Wall Street at Its Own Game. Well, Lee Munson, is this rigged money? I mean, you've had a heck of a run, setting records left and right. Earnings, profits, the mother's milk of stocks, Lee, are outperforming as they have for the last 2-3 quarters. You think this is rigged?
I don't.
Attaboy.
I think that first of all, everybody was so concerned last week because Apple wasn't hitting new highs. This is before Wednesday, and the Bears said we don't have any bellwether leadership. But now it's what? Profits from Apple. Now all of a sudden we have new highs, 22. Number two, Larry, on the intermediate, frontier here, real output's going higher, productivity still higher, durable goods shoot up. Since the election, here's what we have to give Trump credit for. We have to just give the devil his due. He increased CEO confidence, and we see that in the niche book. I'm not trying to get too wonky here, but we have to understand when profits are coming through at record pace and we have good CEO confidence, that means they're going to make capital expenditures. I felt great last week. I bought some new computers for my own, $10,000 out the door. I think if you see a 10% correction or just a pullback, it happens all the time. You buy it. Why? We don't have an inverted yield curve, right? Balance sheets aren't going to get damaged until we have that inverted yield curve. So as long as confidence is up, I'm not even concerned about jobs. I'm concerned about jobs, but it's cheap. So I think that what the listeners need to understand is as long as we have big with pocketbooks writing checks to buy new stuff, which is what it all looks like, profits will go higher. We have no wage inflation because labor is cheap. As long as that yield curve doesn't invert anytime soon,
we're in business.
You got to buy the dip. So 10% off. I don't care what we say when the correction happens on television. You buy it.
So let me just, Mr. Kilberg, couple questions here. Number one, the issue of the Fed. Now, the Fed has raised its target rate, more or less in the last year from 0 to 1. Okay, 1.25 is the target range. But I want to ask you another measure of the Fed besides their target interest rate, which admittedly has gone up. I use commodity markets. I use gold. I use CRB spot. I use the 10-year break-even tips. None of that is really showing any inflation, point number one. None of that's showing any tightening. If the Fed are really tightening, those commodities and gold would be plunging, and they're not. In fact, they probably are rising a little bit. So let me begin with that thought. Are the market price signals, commodities, gold, rising or not? Is the dollar falling or not? Let's start there.
I think that's the most pertinent point, Larry, and spot on the dollar. And I want to push back on the stock market. We'll talk later about that. But the U.S. dollar, what has Janet Yellen and the Fed done in 2017? And everyone, Larry, from Goldman Sachs to everyone on the street has gotten the dollar wrong. The dollar has dropped about 10% from January. And the stock market, surprise, is up about 10%. But I think you're absolutely accurate to look at what is going on in gold, what is going on in crude. And I think this is the Fed's version of QE4. They've really tried to soften or put that big pillow on the tarmac to land this rate tightening cycle. And I think it's been a very overlooked component. But I think when you see the commodities moving, not in the exact manner they should be when you see the dollar at 15-month lows, but I think it's saying that the Fed is really struggling. They have low unemployment number and they have really low inflation. And that's a predicament or a conundrum that Janet Yellen is in. And I don't know how the dollar turns around, even though we saw a little bit of a jump on the payroll number yesterday.
Yeah, my hunch is the dollar turns around big time when the business tax cuts come in, whenever that'll be. But Jeff, just to push back, because I'm a commodities watcher, or let me say I'm a market price watcher, to second guess the Fed. If you have a broader view, now, you're right. The last 6 months, year to date, gold is up, the dollar's down, commodities are up. You're right. On the other hand, Jeff, you go back several years, let's say 2011, where commodities were booming. I think that was QE2 or QE3. and the dollar was crashing, and then you have a big flip. So correct me if I'm wrong, my dates, but basically the dollar is soaring in 2014 and 2015. Commodities are plunging in 2014 and 2015. So it's really only since the end of 2015 that we've had a reversal and the dollar and commodities. It's not been a big reversal, Jeff. That's the thing. If you look at the chart, it's been a mild reversal. The dollar is off its highs, no question. Gold is above its lows, so is the CRB spot. But not major league, Jeff. That's what I'm looking at.
Historically speaking, you're right, Larry. But if you look at where we've been in the last, let's say, 24 months, these last 2 years, you're seeing the euro at 119. I think this is really relevant and really revealing the global currency wars we have going on. And it all started off with QE1, but now the ECB, Bank of Japan, all these other central bankers are still putting down the gas, and we're contemplating pumping the brakes. So I think that right now is producing a very low volatility market. This 8th consecutive rise in the Dow Jones, 8 new records in a row. I know your favorite show is 8 Enough. It is enough back in the early 80s, but I think right now we have to take a little bit of a breather.
What was it? In the early 80s?
Yeah, 8 is enough. Late 70s, early 80s. This when you were starting to work for Reagan. That was your favorite show, I thought.
Oh, well, I was associate director of OMB under Reagan in the 80s, or the first half of the 80s. The rest of it, I was a young junior economist in Wall Street, working my way up. So, but let me come back. Lee, let's talk about some things here behind the rally. All right, I think we all agree profits are improving. We all agree profits are improving. There may be some agreement. I think you are right. I think Trump has contributed to the confidence factor, and I think you see that. He hasn't gotten his tax legislation through yet, to be sure. On the other hand, he's ripping through the regulations, just what he promised to do, cutting them back. So that's a good thing. What about global economic growth? I believe the IMF this week, or one of these crazy international operations, raised world growth at 3.5%, raised China growth a wee bit. There is no inflation out there. Maybe we'll get back to that later. How much of the stock market is the new perception that the world's economy is getting better?
It is. Well, here's the thing. When we talk about this dollar rally, sort of tying this back in, we had the third largest rally in the dollar since 1970. Okay, so the fact that we're a little bit soft here, by the way, it is because we're waiting on the tax cuts. That's my theory as well. But that's given the shot in the arm international companies need to get back and forth so we can invest in these markets. You see international in dollar terms up anywhere between 18 to 30% over the last 12 months. One thing that we just have to remember, and this is just a basic litmus test, unlike our long rally that we've been sort of recovering since the crash in 2009 and really since 2011, we already had a big global asset sell-off in Europe, in emerging markets, back in 2014 and 2015.
Right.
That was sparked by this currency war
right.
that we're all super enthused about. So when investors are looking to commit capital, they see a big run-up, they see growth. You have to remember that they're coming out of a deep recession that we didn't have.
Yeah.
So if you're looking to commit money and you say, I'd like to put some money at the beginning of a cycle, well, that cycle started, it really bottomed out February 11th, 2016. So I think we can make your listeners make it super easy for them. If this middle of 2009, early 2010 would want to invest in green shoots in America, I would say yes.
Mustard seeds. Mustard seeds, I called them. Mustard seeds.
And I don't quite know what they're called over in France, but I will.
Le Moutar something. I don't know what seeds is. Le Moutar seeds.
So
I used mustard seeds on the air during the 2008 crash, and then Bernanke changed them to green shoots. Everybody was yelling at me for being too optimistic. Yeah, you missed the crash, Larry, and now you're too optimistic. I don't care. I'm a long run player, and this is America. And by the way, there were signs of improvement. So I called them, mustard seeds, the tiniest seed, but they grow into huge trees. That's a biblical thing, and if I was any good at that, I'd tell you the verse, but I don't. But that's where it came from. Just one on the way out, Jeff Kilberg. I want to get you guys into some heavy-duty investment picks. But on the way out, I don't know if you saw it. Jason Zweig, columnist for the Wall Street Journal, very good one on markets. Dow 22,000, et cetera, et cetera. He says small investors are selling. So this is not a frothy market. This is not where the so-called ordinary small investors, are too dumb. I don't believe that, but some people do. And the institutional guys, actually, they've been selling. Actually, since 2000, small investors have been selling, particularly out of mutual funds, but even in this rally. So, Jeff, in 45 seconds or less, it's hard to call this frothy if the little guy's not really playing.
Agreed, and we did see $17 billion in outflows in U.S. equity mutual funds in just the month of July going into fixed income. I think that speaks more to the fact, Larry, of asset allocations and rebalancing. But I think there is caution on the horizon. I know you're talking about mustard seeds, but short term, I'm looking at mustard gas. Because right now, the Dow Jones, we have seen the 12% year-to-date growth. 25% has been attributed just by Boeing. Another 12.5% just by Apple. So if you look at Boeing adding about 700 Dow Jones points, I'm concerned that the full market is not participating. You can say the same thing about the S&P 500. 6 stocks have attributed to more than 50% of the growth in the S&P 500. So I think there's caution short term.
Is that not typical, though? All these rallies, don't you always have a half a dozen standouts?
You do, Larry, but we haven't had a low realized volatility. The VIX is under 10. It's been stuck there for a long time. We haven't seen this type of still freeze-frame motion in so long. The NASDAQ, it's been almost 200 trading days, the longest streak ever we've seen without seeing a pullback of 5%. So right now, it's very concerning.
Coach Holtz, Jeff is calling a little bit of a timeout here. I got to take commercial break. We are a profit-maximizing radio show. Folks, we're talking to two of the best. Jeff Kilberg, founder and CEO of KKM Financial, CNBC contributor, and, yes, former Notre Dame football player under Coach Holtz. And Lee Munson, president and CIO, portfolio wealth advisor, author of Rigged Money. I'm Kudlow. We'll be right back.
More Larry Kudlow next. Free market capitalism is the best path to prosperity. You're listening to The Larry Kudlow Show.
Welcome back, folks. I'm Larry Kudlow. We're talking stocks. Jeff Kilberg, founder and CEO, KKM Financial, CNBC contributor. Lee Munson, president and CIO, portfolio wealth advisors. Lee, just before the break, Jeff Kilberg was going into a very deep bearish crouch. And I want to see if you agree with that or whether you think he'll straighten up, get out of the huddle, and get back on the field, Lee.
Well, sometimes as professionals, we look for something minor and we make it a big deal because we get very passionate about it. We have so much liquidity in this market, Larry, that any pullback, I think we're going to see a pullback that your listeners need to know that's about 5%, not 10. I don't think it's going to be as severe as Jeff said. Can't pick the future, but there's so much liquidity, it'll be short and fast. Let me give your listeners the cheat sheets. 2 things to do with your globally diversified index funds, which is what I do for a living for retired baby boomers in New Mexico. When you see the dollar start surging again, that's where you're going to want to add to your international index funds because they're going to get hit from the currency exposure. Number 2, when we start talking in another month or two about how the tax cuts won't be as sweet and the market declines, maybe Jeff's right, 10%. I love that sale. Maybe I'm right, 3 to 5%. We need to look at your small cap index funds or smaller companies because they're the ones that haven't gone up this year. Why? Because we haven't had the tax cuts, which helps them the most. Tax cuts won't help GE or Apple. They help small cap stocks. Just remember, currency, dollar goes up, add your international index funds. The U.S. markets go down. First, look to add your small cap index funds, then large. Kind of keeps it simple.
That's good stuff. All right, Jeff Kilberg, your response. You're worried that only a couple stocks are rallying, and therefore it's not a real rally. I don't doubt, factually you are correct. But I guess historically, isn't that always the case? You can always find, 3, 4, half dozen leaders out of, let's say, 500 stocks or 30 stocks, and you could have said the same thing, but it's normal.
True, but I'm going to go back to Coach Holzer, Larry. He always talked about WIN. That was an acronym he loved to use. What's important now? And what's important now is I think that we are a little bit overdone in the concentration in the FANG stocks, the tech, and these passive index piling in. That's where my concern is. Longer term, I am bullish. And if we see any type of policy get through in Washington in 2017, this market goes substantially higher. But I am thinking short term right now. I think it's very smart to look at some of the sectors that have been laggards. Energy. You look at the Chevrons, the Exxons, the Halliburton, the Schlumberger. Those are all names that are at discount. And I also look at financials. I like Goldman Sachs. It's down on the year, but all of these financials from Bank of America, Citigroup, even some of the brokerages. Look at TD Ameritrade or Charles Schwab. They will benefit when you see volatility come back into the market. You'll also see rates rise. So financials and energy are on our radar in the event we see this 8 to 12% pullback, which we're forecasting.
All right, so let me ask, though, one earnings report of all the many we get interested me a lot, and it wasn't banks and it wasn't Goldman Trading and so forth. It was Caterpillar, great industrial machinery company, all right, arguably the very best in the world. Cat reported above expected earnings, way above expected revenues, sales revenues, and also indicated that they were getting a big push from a renovated or recovering China, which is supposedly on some kind of infrastructure strategy. So when I heard about CAT, I said, well, that's interesting. That's very interesting. And, of course, domestically. So what do you think about that? What does the CAT story tell you, Jeff Kilberg?
Well, I think the CAT story really speaks volume to the U.S. dollar story. And I know I'm focused short-term here, they're right watching, but look at the U.S. dollar short-term in 2017, down near 10%. That has really boosted commodities, and that has really helped emerging markets as well as some of the established markets in Asia. So that is what has really put the wind in the sails for Caterpillar. So if we do see this, the U.S. dollar come back to par, somewhere near 100, I think that softens and weakens that sort of. Right now, they have a picture of Janet Yellen at the lunchroom at Caterpillar, and they give it a high five or a kiss every day.
Look, the Fed, that's sort of interesting point. Lee Munson, we just got a minute left, but I think the jobs numbers, which were rather good, the inflation numbers are very low, which I love, by the way. I just think that's so great. It adds to real income for the middle class and everybody else. What's your take on the Fed? Give me a real quick thought. When does the Fed raise its rate next, and when do they shrink their balance sheet? I got about 40 seconds.
Years, they're already talking about, $50 billion a month that bond dealers are going to have to pay back. The real question is how inverted that yield curve is going to be. So I'm not concerned about a quarter here or a quarter there. What I'm concerned about
is not the measure.
The Fed. I'm worried about corporate America shooting up short rates too much than the party is.
Jeff Kilberg and Lee Munson, gentlemen, thank you ever so much. I'm Kudlow. Quick break and then immigration. How about that?
How can we not believe in the greatness of America? How can we not do what is right and needed to preserve this last best hope of man on earth?
From Wall Street to Main Street.
We believe free market capitalism is the best path to prosperity.
The Larry Kudlow Show, where money meets politics. He's a former associate director with President Reagan's Office of Management and Budget. He's a CNBC News host. And right now, he's on the radio. Call 1-888-KUDLOW-2. Now, it's Larry Kudlow.
Welcome back, folks. I'm Larry Kudlow. This is the Larry Kudlow Show. Tweet me, Larry_Kudlow. Please be civil, but I'll take them all in. So one of the big news events this past week, very big news event, was immigration reform.